Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 4th, 2026. Hey, I hope you're having a nice weekend. I hope you had a good trading week last week. A lot of drama, a lot of volatility, a lot of movement last week in the market. So I hope you hung in there. I hope you were safe. I hope you had some good trades. And like I said, I hope you enjoy the rest of your weekend and that you'll have a good trading week next week. So thank you for coming to my weekend review podcast. I hope you are going to find it helpful. If you do, really, I would appreciate it if you could hit the thumbs up button. It really helps out the channel. So the format for today's podcast is, first of all, we're going to run the US legal disclaimer. Secondly, we're going to come back. We're going to look at all the positions and trades that I made last week. We are going to talk about when I entered the trade, why I entered the trade, what the signals were, what the confluences of signals were for me to enter the trade, how I position size based upon the current market volatility of the market, how I place my emergency stop, how I place my end of bar stop, how I take partial profits if the market starts to move my way, how I go into trailing stop mode, and then ultimately how I am going to exit the position if it gets to overbought levels. So we're going to talk about when, why, and how I am going to manage the trades moving forward. And hopefully it will give you a good idea of how I look at trading, how I look at risk, how I try to always look for confluences of signals, have a good risk to reward ratio so that if I'm wrong, I can hopefully be wrong small. And if I'm right, I have the potential for a large outsized gain. It's been difficult trading this month for sure. A lot more, probably the most difficult month I've had in years, but these things do happen, everybody. So if you're having a challenging time, just remember, volatility is followed by non-volatility. There will be a time where the market rallies. Problem is, I just don't know when. So in the meantime, all I can do is take my signals, follow my rules. So after we take a look at my positions, we're going to talk a little bit about trader psychology. It is the most important skill in trading, is the ability to follow your plan. There are a lot of good trading plans out there, a lot of good trading processes out there, but if you don't follow it, it's not going to do you any good. So you need the discipline to follow the rules. And so I always like to teach trading psychology. Hope it's helpful, or it is helpful for me to teach, and I hope it's helpful for you to hear. After that, I just got done going down through my master watch list for the upcoming week, and I have identified some potential confluences of signals and levels that are confluencing together, meaning they're coming together at the same level. And these may be potential new trades for me next week. Now, they're not there yet, but they are within striking distance. So I'll go down through each one, explain the confluence, explain what I'm looking for, and then if I do take the trade, what my stops are going to be. So anyway, I hope you're going to find this helpful. I have a lot of people message me and say, hey, I really like to see what your picks are for next week. Gives me an idea of how you think and how you look at trading. So hopefully it will be helpful for you too. So let's run this US legal disclaimer, get this out of the way, and then we'll get started. So hang tight for about 40 seconds. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, well, let's get started. Hey, I had something pop up on YouTube the other day, and it told me that my YouTube channel has been up for 7 years. So I've been doing this for 7 years. Unbelievable how time goes past for 7 years of doing this every day and every week. So anyway, let's get started. So Palantir, I am currently in Palantir. I did enter Palantir back here on the 5th of February at 129.62. You can see it's been a pretty good trade. There's been a lot of ups and downs, but it definitely has been a good trade. But I took the trade here on the 5th at 129.62 because it rejected the bottom of the order block. The order block is this green box that I have here. And you can see during the day we went under the order block, but we closed back in the order block. And I make all of my buying selling decisions based upon the closing price of the day. I feel like it is the most valid price of the day. So, but there are many different ways to enter order blocks, but on this particular trade, it was because it went below the order block during the day, but was strong enough to close back above. So first, let's talk about what is an order block. And this order block was formed in the past. And this is how order blocks work. They form in the past, and then you bring them into the future. So uh, uh, for an order block to be valid, first of all, we need to start with something called a swing low. A swing low is simply a low that has a higher low to the left and has a higher low to the right. So this is a swing low, higher low left, higher low right. After we have that first swing low, the next thing we need to do is have a swing high. A swing high is the opposite. Here's a swing high. Swing high has a lower high to the left and a lower high to the right. So far we've got what we wanted. We need a swing low followed by a swing high. After we have those two in place, we need to have another swing low that is lower than the first swing low. And you can see here is our other swing low that is lower here. Higher low to the left, higher low to the right. So now we have the first three things that we need. We have a swing low, we have a swing high, and we have another swing low that's lower than the first swing low. When these three situations are in place, now I have to go back to the initial first swing high, right? Swing low, swing high, lower swing low, but I need to key off of this swing high. Now, once the swing low, swing high, lower swing low are in place, if then in the future, if the price can move over that first swing high, now what we've done, we have changed market structure to the upside. And when market structure changes to the upside, now I can identify my order block. And my order block, the way that I trade order blocks, people trade them a lot of different ways. But this is how I trade them. They work very well for me, is that I look for the lowest closing bar prior to the market structure change. So swing low, swing high, lower swing low, market structure change. As soon as this happens, now I know that the lowest closing bar prior to the market structure change, the high and the low of that, is my order block. And you can see I take the high and the low of that and I move this green band into the future. And what I'm waiting for is I'm waiting for the price to come back down to this level. You might ask, well, why are you waiting for that? Well, in this example, swing low, swing high, lower swing low, market structure change, when it changed structure, it really went, didn't it? I mean, it got all the way up to here. And now we're using hindsight here. But once the market was up here, all the way up here, I could confidently look back at this order block and say, clearly, in hindsight, there was smart money was buying this area, right? Yeah, for sure. When you're up this high and you look back here, smart money was buying that. So I'm looking for this smart money area to bring this smart money area into the future so that if it goes back down to that smart money area, now I'm looking to buy smart money again. Now, just because it was smart money here doesn't necessarily mean in the future if it gets back there that it's smart money then, because things change, right? Politics change, the economy changed. But from using order blocks for so many years, I can confidently say it's smart money more times than it's not smart money, right? So, okay, swing low, swing high, lower swing low, market structure change, define the order block, bring the order block into the future. Now, there was many months it did not get back to the smart money area, but here it finally did. And this was my entry here, again, on the 5th of February, 129.62, because it went below the order block during the day and then close back in it. That's called a rejection of the bottom of the order block, and that is a legitimate entry. So, okay, there's my entry. So once I have my entry and I decide, okay, this is a legitimate entry, I have to decide what my position size is going to be. I have to decide how much I'm going to buy of this particular new stock, of this new entry. So I need two things for that. I need what is the account value of my trading account, and what is the 2 ATR value. Here it says average true range 2. Right now on this particular day here, it's $13.17. And all this does is measure what the average range is, what the expected range is of this particular market on any particular day, and times that by 2. So when volatility is higher, this number's larger. When volatility is lower, this number this number is higher. When volatility is lower, this number is lower. And I'll show you when we do the math here why that's important. So essentially, when volatility is high, by using this 2 ATR number, I'm going to buy fewer shares. When it's lower, I can buy more shares. And so first thing I need to know, how much is in my trading account? Let's just say I have a $100,000 trading account. I times it by 1%. 1% of 100,000 is 1%. If I have a $200,000 trading account, 1% is 2,000, and so forth. It works with any amount. So for this example, let's just use 100,000 times 1% is $1,000. That's going to be my maximum allowed loss on this trade. Okay. Very unlikely that I'll lose $1,000 on this trade, but I have to have the worst case scenario. The worst case scenario for me is going to be 1% of my account, $1,000. So I take that 1% of my account value and I've divided by the value of the 2 ATR. Right now it's 1317 divided by 1317 tells me to buy exactly 75.9 shares. So I'll just round that up to 76 shares. So based upon the current market volatility and me wanting to only lose $1,000, 1% of my account, this is the right amount of shares for me to buy. Okay, so I buy 76 shares right here, 129.62. Now, the very first thing I do is I take my entry price minus whatever the value of the 2 ATR is, and I subtract it from my entry price, and I place my thick red line down here. This is my emergency stop. If for some reason the next day it goes down all the way to this emergency stop, how much will I have lost? I would have lost $1,000. I would have lost 1% of my account because we just did the math, right? 1,000 divided by 1317, and then taking 1317 minus my entry price. So, and this does happen, hitting your emergency stop. But the good news, it only happens about 5% of the time. The other 5% of the time, if you have a loss, if I have a loss, it is not going to be because I hit my emergency stop. It is going to be because my end of bar stop, okay? 2 stops, emergency stop, end of bar stop. End of bar stop depends on the strategy that I'm using. But on this particular trade, we went under the bottom of the order block, closed back above the order block, not very far above it, but back above it. So in the future now, my end of bar stop will simply be a close back below the order block. And you can see it never closed back below the order block, so my end of bar stop never triggered. But the key is here, look, I'm at 129.62 on my entry. If the next day it closed even 1 penny below, okay, it's my end of bar stop. I have to get out of the trade, but I don't lose much money. Remember, even if it goes all the way down here, I've only lost 1%. So maybe I lose, I don't know, a tenth of a percent or something like that. But that's the key when I talk about risk to reward, is getting in very close to where you should get out for your stop. So if you do, it doesn't have to move much. You don't have to lose much before you have your stop. All right. Okay. So we rejected the bottom of the order block. I position size correctly. I entered. I placed my emergency stop 2 ATRs below my end of bar stop. As I just mentioned on this particular entry, it's just a close below the low of this order block. Okay. The next thing I do is I take my entry price and I look to the value of the 1.5 ATR. Right now, the value of the 1.5 ATR is $9.88. I take my entry price plus whatever the value is, the 1.5 ATR, and I place it above my entry. this is my trailing stop mode. This just means in the future, if I'm fortunate enough to have the stock move in the direction that I want and it gets up to that level, now I say, okay, it's moved a nice, decent way for my entry. And generally in trading, if you have a nice move up, you want to start to tighten your stops up because you don't want to give it all back. So I leave all my stops where they are, but what I do is if I take the trade and it gets to it's called my trailing stop level, if it gets there, now in the future, if I have a close below a previous bar's low, I'm going to exit half of the remaining shares that I have. That has the same effect as moving all of your stops up. Okay. And 1.5 is a good level for you to get to because it's moved beyond noise. It's moved above 1 ATR. So, and I'll wrap this all up after I finish this explanation here. But when I enter, if I get to trailing stop mode, again, it doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to exit half the position. Okay, so everything we've talked about so far, emergency stops, end of bar stops, going into trailing stop mode and selling half if you have a close below previous bar's low after reaching trailing stop level, these are all defensive moves. These are moves where if the market goes against me, I have to take some action defensively. But I also like to play offense in trading as well, not just defense. And the way that I play offense in trading is I take a partial profit if it moves a certain amount from the previous bar's close. Not all, just a partial, because I'm a big proponent of if the market gives you something, take something. All right. So let me show you how I'm going to do this I'm still in this trade. So I'll show you how I'm going to do this for Monday. It's very simple. All I do is I take the closing price of the day. Thursday's closing price was 148.47. And now I'm going to look to the value of the 0.45 ATR. Right here, the value of the 0.45 ATR is $3.05. So the closing price plus 3.05. My first profit target for Monday is 152. What did that say? 152.52. All right. So 152.52. That's my first profit target for Monday. And I will put a limit order in for Monday only and say, if it gets here, sell some. How much is some? It's 10% of however many shares I go into the day with. If I go into the day with 50 shares, I would say, tell my trading platform, take 10% of that, 10% of 50 is 5, and sell that at 152.52. Now, I place 3 profit targets every day, not just one. So the first profit target was the closing price plus the value of the 1.5, times plus the value of the 0.45. That gives me my first profit target, 152.52. To get my second profit target, I just take my first profit target, 152.52, and I add the value of the 0.45 to it again. So plus 3.05. My second profit target for Monday is 154.57. Okay. And I do it one more time. I place a third profit target. I take the second profit target, 154.57, again, plus 3.05. My third profit target for Monday only, 157.62. And again, whoa. There we go. Wait. 154.57 plus 3.05. They should be equidistant, 157.62. Okay, you know what? I think I had a number wrong to begin with. So let me start again. Sorry, 148.47 plus $3.05. My first profit target's 151.52. Oh, I see what I did. 151.52. Okay. And then 150, 152, adding again, 3.05. My second profit target is 154.57, yes, and added again, plus 3.05. I typed the wrong number to begin with, that's why it messed me up. Okay, so those are my 3 profit targets for Monday. And again, if I go into the day with 50 shares, I put an order in to sell 5 here, 5 here, 5 here. Look, if I have a big day, if it moves up, and I hit 3 profit targets. Fantastic, right? I've reduced my position size. I've locked those in. Every time I hit a partial profit, it has the effect of moving my stop up even higher. And it reduces your position size. And if you reduce your position size, you're less stressed. And if you're less stressed, you're more likely to follow your plan, right? So there's a lot of advantages, but it just makes sense, right? With sports, you have to play offense and defense. You can't just play offense or defense. And in trading, you can't just play offense or you can't play just defense. In my opinion, you need to play in both. So my end of bar, my emergency stop, my end of bar stop, going into trailing stop mode, these are all defensive moves, but taking my partial profits each day offensive. And look, if we go down on Monday and I don't hit any of those profit targets, then I have to recalibrate, take the closing price of Monday and add the 0.45s to them again. And it's just nice and fluid. If it moves up, the profit targets are higher. If it moves down, the profit targets are lower. Okay. All right. So those are the basics of kind of how I look for the order block and so forth and so on. So now let's just go through the trade from the beginning, just from the start. I always think it's a good idea to kind of try to bring this all home. So, okay, I enter here on the 5th of February, 129.62 with a rejection of the bottom of the order block. I position size, I place my emergency stop 2 ATRs below. My end of bar stop closed below the order block. Once I enter, I place my 1.5 ATR trailing stop level above. Here we go. Next day, goes up. I hit a profit target. Fantastic. Next day, goes up again. Nicely. I hit 2 profit targets. And now I'm in trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half of the remaining shares that I have. Next day was down, but it didn't close below previous bar's low, so I do nothing. Next day, yes, we did close below a previous bar's low after reaching trailing stop level. What do? I took off half of the shares that I had remaining right here, but I also kept half. And it was a gain of 4.61%. The next day down, during the day, it was below the order block. Had it closed there, I would have gotten out, but it closed back in, keeping me in the trade. The next day was up a little bit where I hit a profit target. Next day, again, was below the order block, but closed back above it, kept me in the trade. No profit targets, but kept me in the trade. Next day, at one point during the day, it was up quite high. I hit a profit target into that strength. And then we moved down, and here we have 2 days where during the day we were under the order block. And the only reason I stayed in the trade was because it closed back above. Next day was below, closed back above. That kept me in the trade. So you can see the market was respecting the bottom of that order block. There were no sellers there. Then we had a nice move up. Profit target here, couple profit targets here, couple profit targets here, couple profit targets here, right? I sold into that strength. And then we started to move sideways. We didn't have much. We had a nice profit target here on that strength, which I'm glad I took, right? And then we moved down for 5 straight days. So we moved down, we moved down. Then we had the big bounce here on the 31st where I took multiple profit targets into that strength. We were up a little on Friday. So I'm still in the trade, right? As long as it closes above the bottom of this order block, I'm going to stay in the trade. If it moves up, I'm going to continue to take partial profits. Now, if we get to a 65 RSI level or a 70 RSI level, then I have other rules that come into effect that will completely get me out of the trade. Just kind of as an example, if we get to a 65 RSI level, then at that point, if we ever close below the 5 EMA, I'm completely out of the trade. If we go up and reject the 70 RSI, I get out of half of the remaining shares that I have. And if that happens, rejection of the 70 RSI in the future, if I have a new close below previous bar's low, then I'm completely out of the trade. So I have rules for everything here. And that's the key in trading, everybody. You have to have if-then statements. If this happens, then I'm going to do that. If that happens, then I'm going to do this. But if you just buy and sell based upon how you're feeling in any one particular day, you're going to have a rough road. You're going to have a rocky road with trading. I've been trading for over 30 years, and I am convinced for the majority of people, you have to have a systematic trading strategy that tells you exactly what to do each day and not relying upon you becoming impatient or emotional and making quick, fast, emotional decisions. All right. So the remaining shares that I have on this particular trade doing pretty good. Very happy with the trade, up 12.65%. All right, let's go to silver. All right, I've been in silver for a while, and I did enter silver here on the 18th of February at 69.80. Now, you can see we have a green order block here from the past, and on the day that I bought it because for two reasons. The first reason is it rejected the top of the order block. Palantir that I just showed you rejected the bottom of the order block, but this is a rejection of the top of the order block because the previous day closed in the order block and then it closed back above the order block. That's a rejection of the top of the order block. It is a legitimate entry. But in addition to that, I took it for another reason. You can see the bar before, I have this highlighted in blue. Why did I highlight this in blue? This is what's called a bullish abandoned baby. An abandoned baby is formed when the previous day gaps down. You can see the previous day's close to this day's open gap down. That is bearish, right? Sentiment is bearish. However, the very next day, it gapped up. And if you have a gap down, so you have a bearish environment that immediately gaps up and has a bullish environment in a very short amount of time, that's important. There's a lot of things going on under the hood there. But the reason these are called abandoned babies is because they kind of look abandoned down here. But these are very strong signals. They don't, I mean, when you get an abandoned baby, it doesn't always mean it's going to go straight up. Sometimes it comes down, but more times than not, this quick move between bearish, overnight bearish to bullish the very next day gives you an edge in the future that I could say more times than not, you're going to be higher. So that's the reason I took the trade, everybody. I took the trade because we gapped down and we gapped up, forming a bullish abandoned baby, and we also rejected the high of the order block. So you can see I have two combinations of signals. Now, when I trade an abandoned baby, like with Palantir, I take partial profits, I go into trailing stop mode. I do that on all the strategies I trade except for this one. On this one, I make it very simple. I position size so that if I'm wrong, I lose 1% of my account. I place my emergency stop 2 ATRs below. But when I take a trade with an abandoned baby, I have a 2 ATR stop to the downside with a 4 ATR profit target to the upside. So if I'm wrong, I'm going to lose 1%. If I am right, I'm going to make 2%, that's good trading. That's asymmetrical risk, right? I have the ability to make twice as much as what I'm willing to lose. And when I have abandoned babies, I'm more confident that in the future they are going to be higher than lower. So I have a better chance of making 4% on my 2% on my account than losing 1% of my account, right? So I took the trade here on the 18th of February at 69.80. It immediately started to go my way, doing great, and then it came down, and then it really came down. So I am underwater on this trade at the moment. At the moment, I am down 5.88%. Now, I'm not really down 5.88%, right? Because I position size, so if I hit my emergency stop, how much do I lose in my account? Only 1%. So I'm probably down a quarter of a percent, right? But it's the position sizing, taking the maximum allowed loss divided by the 2 ATR, and that's what I did. And so yes, if I had a $100,000 trading account and it went down here, I'd lose $1,000. But with the position sizing that I have and where the price is from my entry, it is a loss of 5.88. And so with this particular trade, I'll just wait it out. For sure, one way or the other, it's either going to hit my 4 ATR profit target or it's going to hit my 2 ATR stop. And in the meantime, I just sit and wait. One of those two things will happen. But currently down 5.88% on that trade. AMD. AMD's been a really good trade. Again, this is an order block trade. I use order blocks in the majority of my trades, not all of them, but the majority. But this order block happened from the past. Now, so far we've talked about taking a trade from the rejection of the bottom of the order block. We've talked about taking a trade with the rejection of the high of the order block. But really, my favorite way to use order blocks is when I have a major long-term average that lives inside of the order blocks. And a major long-term average would be a deep dip buy moving average. The way that I use it, the way that I teach it, is the 200-day moving average, which is the black line right here. But I also use the 250-day moving average, and I use the 300-day moving average. I love when there's a major long-term moving average like the 200, 250, or 300 that lives inside of my order block. It's a key level. A 200 is a key level always, but it's a key level within another key level of the smart money area, the order block. So on the day that I took this trade here on the 30th of March at 196.10. Why did I take it? I took it because intraday we went below the 200, but by the close of the day, it closed above. That's called an intraday rejection of the 200-day moving average. So that was my entry signal. So I position size, bought the correct amount of shares based upon the volatility. I placed my emergency stop 2 ATRs below. If it gets there, I lose 1% of my account. My end bar stop would simply be a close below this 200-day moving average. And I started the trade so close to it anyway, so even if the next day, if it would have gone down 3 or 4 cents, I would have been out for a loss, but a small loss. So again, that's a good risk to reward ratio. So emergency stop 2 ATRs below, end bar stop, close below the 200-day moving average. Of course, I placed my 1.5 ATR trailing stop level above, and away we go. The trade starts. Next day, great. Moved my way. Nice way to start the trade. Hit a profit target. Next day, up again. Hit profit targets on this day. Also got to trailing stop level. Doesn't mean I do anything. It just means now I'm in trailing stop mode, which means in the future, if I have a close below a previous bar's low, I'm going to exit half the remaining shares. On Thursday, clearly we were way below the previous bar's low. But I don't do anything until the close. And you can see at the close, it was higher. So I am in trailing stop mode, but I didn't take half off because it didn't close below the previous bar's low. And in addition to that, it closed so strong that I did hit a profit target and took some into strength at the end of the day. So great trade. And with a really good risk to reward ratio, these are really my favorite. Major moving average, deep dip by moving average, 200, 250, 300 inside an order block. So the remaining shares that I have on AMD looks like up 9.76%. So nice trade there using the order blocks and the major moving averages. McDonald's, very similar to AMD, though it hasn't really moved like AMD. So I did enter McDonald's here on the 1st of April at 307.02. Why? 2 reasons. Intraday rejection of the 200-day moving average and a rejection of the top of the green order block. So I entered here, 307.02, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average, the black line. You can see Thursday we were below it, quite a long ways below it, but it recovered and closed above. That kept me in the trade. So Monday, if it closes below the 200, I'm simply get out. If it moves up, then I'll take however many profit targets it gives me on the way up. If it gets up to a 65 RSI, then the 5 EMA comes into play. If it rejects the 70 RSI, I'm going to sell half and so forth. But right now, we're not even at trailing stop level. So the key thing right now for McDonald's is that it stays above the 200 on a closing basis. But if it closed Monday below 200, I'm out. I can always get back in the next day if it closes back above. Hopefully it won't do that. So I'm basically break even on this trade. I'm up a little, right? 307.02 is my entry. It's 307.14. So I'm up a little. We'll just call it break even at this point. Microsoft. I did buy Microsoft on Thursday, excuse me, at 373.14. Why did I do this? I did this for two reasons. For one, we closed above the high of the green box. We closed above the order block. That's a rejection of the high of the order block. Okay, that's one reason. Legitimate? Yes, it is. But the other thing we had is we have what's called a higher low V2. And I use V1s and V2s in my trading all the time. And by the way, if you want to learn more about those, go to my YouTube channel. Just look up V1s, V2s. I have a video there that explains everything in detail. But in this particular case, it's a V1. A V1 consists of two bars, bar 1 and bar 2. And in order to become a V1, bar 2 has to go below bar 1's low. It clearly did that. And then it has to close above bar 1's close. So two things. First thing, it has to go below the low of bar 1, and then it has to close above the close of bar 1. Well, it did both of those. That is called a higher low V1. It's called a higher low V1 because the bottom here is higher than this previous swing low. Okay, really good signal. So, but it's the combination of signals. It's a V1, it's a higher low V1 in addition to a rejection of the high of the order block. So I entered here 373.44. I placed my emergency stop 2 ATRs below. Now on this particular trade, because we don't have a moving average or we're not near the bottom of the order block, I have to figure out what my end of bar stop is. Well, on a V1 or a V2, the end of bar stop is simply a close below halfway of bar number 2. You take the high, you take the low, halfway of that bar, there's some inherent Fibonacci 50% support. So my end of bar stop is 369.20. Right now it's at 373.42. So Monday, if it closes below 369.20, that's it. I'm done with the trade. Of course, if it goes all the way down to my emergency stop, I have to get out, right? And by the way, I mentioned before I make all my buying and selling decisions based upon the closing price. That is true, except for one exception. If I get to my emergency stop, I have to get out immediately. I don't care what time of the day it is, if 1 second after the market opens or 1 second before the market closes. If I hit my emergency stop, that means I have lost 1% on my account. That is the maximum I'm allowing myself to lose, and so I can't wait for the end of the day. All right, so that's the one exception. So going forward, if it moves up on Monday, I'll take profit targets. If it closes below 369.20, I'm out of the trade, right? I can always get back in the trade. So again, you have to have a plan and know exactly what you're going to do regardless of what the market does so that you don't make impulsive decisions. So I'm break even on this trade. I just entered on Friday 373.44. Okay, so those are the open positions that I have at the moment. Now, I did have a couple losing trades that I had to get out of last week. The first one was Apple. I bought Apple here on 3/20/26 at 247.80. Why? Because it intraday rejected the 200-day moving average. So I entered 247.80. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 200-day moving average. I place my 1.5 trailing stop level 1.5 ATRs above. Next day, gapped open huge. It was a great start to the trade. I hit multiple profit targets on this day. Next day, I hit another profit target when it was near its high. Next day, didn't do much. Next day, I did hit another profit target near its high, and it also, before it kind of sold off, but it did on this particular day, it put me into trailing stop mode. Doesn't mean I do anything. It just means in the future, if I have a close below previous bar's low, I am going to get out of half. That's what happened the very next day. This is the first close below previous bar's low after reaching trailing stop level. What did I do? I took off half of my shares for a gain of 0.43%. Better than nothing, right? But then the next day we closed below the 200. That was my stop. I had to get out. So the remaining shares that I had, I took a small loss of 0.45%. But let's revisit the importance of taking partial profits. Am I glad I hit multiple profit targets here and one here and one here? Yeah, of course. it mitigated the loss that eventually came by selling these here. And then, of course, when I went into trailing stop mode, I sold half of what I had there at a profitable level. So the remaining shares on Apple, I did have to get out at 0.45 for a 0.45% loss. Now, the next day, we had a big rally. Yeah, it kind of sucks, right? I got out, next day it rallies. It's fine. It happens. So could I have taken this trade here on the 31st with the close back above? I could have, but I didn't. Well, I did, but in a different way. I didn't take the trade because, yes, it is valid, but the risk to reward is not good. There's a long way from here to the 200-day moving average. I'm not starting off with a good risk to reward ratio. So what did I decide to do? What I decided to do was, okay, it moved too fast. It looks pretty strong, but I don't want to buy this because it's moved too far too quickly. So what I did, everybody, is I sold puts down to 247.50. I don't do this a lot, but I do it, especially in a situation where there's a big reversal in the market with a bad risk to reward ratio. So I sold puts to 247.80, expiring on the 10th. So at the end of this week, they expire. Now, when you sell a put, so my strike price on the put's 247.50. If it closes above 247.50, I keep all the premium and I made money that way. And it paid pretty good. It paid almost 2% for, I guess, about 10 days, right? I do a lot with options. I don't talk a lot about it here on the podcast. I just talk about swing trading, but I do use options a lot, selling calls, selling puts, so forth. So when you sell a put, I'm not going to just let it go down and see if it closes below there. I still have rules, right? I have my 2 ATR emergency stop below. If it gets there, I automatically get out of the put. If I close below the 200-day moving average, I also have to get out of the put for a loss. But if this just moves sideways or slightly goes up or goes down but stays above the 200 and the option expiration period comes, I made 2% on the trade. Not too bad. And that's why I like selling puts in the right situation, because I have downside protection and I have a lot of premium. So I'll keep this up here for next week just to monitor this. But again, I sold the 247 strike prices. I have my emergency stop 2 ATRs below, and my end of bar stop for the trade would be a close below the 200-day moving average. Okay, Qs is another trade that I had to get out of. I entered the Qs here. It was the right idea, but one day got me out of the trade. I entered the trade here on the 27th of March at 562.57. Why? Because it rejected the orange line. The orange line is the 300-day moving average. It rejected the 300-day moving average inside an order block. So I entered 562.57. I placed my emergency stop 2 ATRs below. The next day, though, it closed below my end of our stop, which was 300-day moving average. So I have to follow my rules. I had to get out, and I took a loss. Not bad, but I took a loss of 0.77%. Now, the next day, it ripped higher. Could I have bought this again? I could have, just like with Apple, but I did not. Could I have sold puts back down to the 300? I could have. Certainly, I could have, but I didn't, right? I did that on Apple only. So I did take a loss on this trade of 0.77. You can see I was one day off of the bottom, at least so far. But in the future, if we come back to that 300-day moving average, I would consider buying again. But when we go through the trades for next week, we'll revisit the Qs. But this particular trade with the rejection of the 300 inside the order block, next day it closed below. I had to get out for a loss of 0.77%. All right. So just to run through quickly on the open and closed positions, PLTR, current remaining shares up 12.65. Silver down 5.88. AMD up 9.76. McDonald's right about even. And Microsoft, because I just entered the trade, right about even. Apple had to get out of the remaining shares for a loss of 0.45%, and the Qs a loss of 0.77%. So in trading, you're always going to have losses, but what you're trying to do as a professional trader is have big wins, medium wins, small wins, but small losses, right? And right here, it's pretty much what I've shown you. The silver loss was a little bit higher, but you can see, I had less than a 1% loss on the majority, but I had some double digits on the winning trades. And so that's really what it is. You're trying to let your winners run and you're trying to cut your losers short. I always tell my students, and anybody that will listen, be very patient with your winners and be very impatient with your losers. You can see Apple, I was in for a few days. Qs, I was only in for one day because it turned into a loss. I was very impatient with it. But something like Palantir, and AMD, I've been in them for days, right? Because they're working. And so if they're working, I keep them. All right, let me finish this up with UUP. Now, the trades that I showed you were on the daily time frame, but I also trade the weekly time frame. Weekly time frame, every bar here is a week. And I make my trading decisions on Friday because that's when a weekly bar closes. So I've been in this trade for a long time. Let's go back to where I entered the trade. I entered the trade all the way back here on 7/11/2025 at 26.31. Why did I enter this trade? Two reasons. The first is that we rejected the high of the order block. The previous week we closed in the order block. The week I entered the trade closed above the order block. That's a rejection of the high of the order block. It's a legitimate signal. In addition to that, look, we have a 200-week moving average here. And the previous week we closed below it. The week that I entered, we closed above it. So I have two signals. I have a rejection of the high of the order block, and I have a close under, close over the 200-day moving average. Both valid signals. So I entered here 26.31. I position size, as I should, based upon volatility. I put my emergency stop 2 ATRs below as always. My end of bar stop is simply a close below the 200-week moving average. Okay, let's see what happens. Next week, started off nicely. Great, hit a profit target. Next week, came back down, tested the 200 intra-week, but closed above it. Kept me in the trade. Next week, we went up very strong. I hit multiple profit targets in this strength on this particular week. I also got to trailing stop mode. The next week was down, but it didn't close below the previous bar's low, so I did nothing. But the next week, we did close below a previous bar's low after reaching trailing stop level. What do? I took off half of the position that I had for a gain of 0.49%. All right, but I still have half. Then for a few weeks, 4 weeks, we just went sideways, nothing. This particular week, the week of the 9/19, during the week, we were well below the 200. And I thought, oh, I'm definitely going to have to get out of this by Friday. But when Friday came, we closed back above it. It kept me in the trade. Next week, we were up, hit a profit target. Next week, we didn't do much. Next week, up again nicely, hit another profit target. Couple weeks of sideways motion. Next week, up again, sold into the strength, took a profit target there. Moved kind of sideways for a month. Move back down, sideways, sideways, sideways on this week here, took a profit target. Then we went down for 3 weeks. During that week, we were well below the 200. I thought, well, this is it. It's the end of the trade. But when Friday came, we were above it. It kept me in the trade. Went up a little bit, went down, held the 200, went up again, profit target. Next week, nothing. Next week, up nicely, profit target into strength. Next week, up nicely into strength. Now, this particular week got us to a 65 RSI. So if you get to a 65 RSI or higher, the 5 EMA, this is the thin blue line, comes into play. So this trade is very easy going forward. If it closes below the 5 EMA, it's the end of the trade. If we go up and we reject the 70 RSI, I'll sell half. If that happens in the future, if we have a close below previous bar's low after reaching the 70 RSI, that will be the end of the trade. So right now, here's this 5 EMA. The 5 EMA is 27.70. If it closes below, that's it. I'm done with the trade. It's been a really nice trade. And this particular trades to date is currently up 5.56%. All right, so that's what I have as far as the open positions, the closed positions. And before we take a look at next week's potential entries, let's talk first a little bit about trader psychology, all right? All right, so this week's trader psychology comes from Stephen Goldstein. Stephen Goldstein's great. He has a great podcast called Alpha Mind. And I've been lucky enough to be featured on or as a guest on his podcast. It's a great podcast because he interviews traders from all over the world, hedge fund guys, large financial institution guys, prop guys, and retail traders like me. So I was fortunate enough to be a guest on his show. If you get a chance, follow him at Alpha Mind 101 on X and watch his podcast. So and Steve is a very famous trader, very famous trading coach. So when Steve says something, it is definitely worth listening to. So let's see what he talks about. The profit paradox. If you chase the money, you lose the process and eventually the money. If you master the process, the profits take care of themselves. Great traders keep their eye off the scoreboard and focus on the play. 100%. And I tell my students this, I tell any trader that will listen, here's the paradox. If you concentrate on making money, you're going to lose money. If you concentrate on saving your money, you're going to make money. And this is basically what Steve is saying. If you chase the money, you lose the process. Because if you're focused on making the money and you take your eye off the process ball, now you're not following the process. And ultimately, you're going to lose the money because you're not following the process. But if you focus on the process, if you master the process, if that's your main reason for being in trading is I'm going to, like a laser beam, focus on the process and follow every single rule. Ironically, that's when the profits take care of themselves. Great traders keep their eyes off the scoreboard and focus on the play, right? Whether you're playing baseball, football, soccer, cricket, whatever, you're not looking at the scoreboard, you're looking at playing the game, right? If you look at the scoreboard and not play the game, something bad's going to happen in your game, right? I know it's kind of a cliche, but it is true. Keep your eye and focus on your process. If you do, and it's a good process to begin with, good risk to reward ratios, patience, proper position sizing based upon volatility, all of this, the profits will take care of themselves. So thank you very much. Please follow Steve at AlphaMind 101, and I highly recommend it. Thank you, Stephen, for the great post. All right, so these are the 6 symbols, the 6 tickers that I'm looking at for next week. They are not where they need to be yet, but they're getting pretty close. And if they're close and they trigger, they could offer some high probability trades, right? Doesn't mean they're going to work, but like with any setup, with any structure of a trade, you structure it so that if you're wrong, you can be wrong small, and if you're right, you can have an outside gain. So here are 6 symbols for next week. Not a lot with the current market that we have. We had that bounce, so there's not a lot of good risk to reward ratios on some particulars, but these have pretty good risk to reward ratios depending how they play themselves out next week. But the one thing that I want to mention here, I mention each week, is that okay, on Monday it is theoretically possible that all 6 of these could trigger. Does that mean I would take all 6 positions? No, it does not. I only take 1 position per day. I don't care if all of the candidates or the new entry signals are perfect. I still have to narrow it down to best one. And I can always find what's the best one. And what I take into consideration is how many entry signals do they have? Maybe one has 1 entry signal, the second has 2 entry signals. Well, of course, I'm going to take the one that has 2. Maybe one that has 4. Well, I would more consider that. But you also have to factor in the risk to reward ratio. There just like on just what it was when we had the big rally last week. Great signal, but I didn't take it because the risk to reward ratio was not good. So you have to factor all this stuff in. So I give it a quality score based upon how many entry signals it has, what the risk to reward is. I look at the higher time frame to see if the higher time frame is telling me maybe I have some kind of support or entry signal on the higher time frame. Like if I'm trading the weekly, maybe or the daily, maybe I look to the weekly. And then I also look at relative strength is important too. Was the market down, but this stock was up? Okay, maybe it gets an extra bonus point. All right. So this is how I trade, and this is how I teach my students to factor all this in to come up with the best trade. And just put in a little plug for myself. I do teach students all over the world. I teach a 20-hour one-on-one course. I think it's a great course. I've had many people tell me it's the best course they've ever taken, but I think the best way to learn anything is one-on-one. And so I've taught people from all over the world. I teach in our 20-hour one-on-one course. We do it 2 hours a week for 10 weeks. So we see a lot of different changes in the market through that 10 weeks. And I teach you step by step all the trading strategies that I use. I teach you all the rules. I test you on those. We do a lot of simulation trades. And I have turned out some really good traders. I've got to be honest, I've turned out some great traders. And I've taught traders all the way from absolute beginners. I have a student this week, complete beginners. They don't even know what a chart is, right? Well, they kind of do because we've had a lesson, right? But they're completely new. But I've also taught absolute pros, hedge fund owners, hedge fund managers, hedge fund traders, and I teach them all the same thing because really the stuff works. So if you would like to be my student, I would be happy to have you as my student. I will teach you everything that I know. It's very important to me that my students become very good traders and have a skill they can use the rest of their life. So if you're interested, my email is in the link of the YouTube video. Just send me a email and we can, start talking about this. The 20-hour course is $2,000. Yes, it's a lot of money. It's an investment, but it is an investment. It's an investment in something of a skill that you are going to be able to use for the rest of your life. So if that's of interest to you, please reach out to me. I'd love to hear from you. If you like online courses, I have a really good online course available at udemy.com. The link's in the description. I teach you the deep dip buy strategy. It's a 9.5-hour course. There's a lot of content there. And I think I have 4.85% stars out of 5. And I've sold so many around the world. So that's a good place to get started. It's not as good as the 20-hour one-on-one because I teach you all the different trading approaches, but it's a place that you can get started as well. So if you're interested in the one-on-one course, you're interested in the online course, the information is in the link below. So thanks for letting me put my plug in, and let's get back to business. So let's get back to Alibaba. Boy, Alibaba has had a fall, hasn't it? It just keeps going lower and lower and lower and lower and lower. I mean, I could go back all the way and you can see it just has gone down. But nonetheless, there is an order block from, I think it's over a year ago. It took me a while to place this order block tonight because it was so far back. But nonetheless, we are coming to very close to an order block. All this means is in the past that this order block, that was a low before it took off. So that was smart money, could be smart money again. So there are no moving averages. Well, there are, but they're up here, 200, 250, 300. But I'm looking for some kind of level in this order block. Now, I could potentially take a rejection of the high of the order block. That would be legit. Looks like the high is 119.36. The low of the order block is 116.83. But really what I'm looking for is I'm looking for a deep dip buy. I'm looking for an under 30, over 30 RSI inside the order block. Right now we're at 33.97, so we're getting pretty close to the 30 RSI. So next week, if we do go under the 30 and back over the 30, either intraday or day to day, and it happens inside this order block, that would be a legitimate entry. If I take the trade based upon an under 30 over 30, then my end of bar stop would be a subsequent close below the 30 RSI. In addition to that, I do want to point out the MACDs. And again, this is something that I teach in my course, but we have some pretty significant MACD divergences. Let me show you the divergence. If we take this low here, and then we look at the depth of these MACD bars, you can see this low corresponded with quite deep MACD bars. The deeper these MACD bars, the more momentum, downward momentum there was. So if I see a low that has deep red MACD bars, and then I see a rally that paints some green MACD bars, and then I go equal to or lower than that low, you can see this low is much lower than this low, yet look at the MACD bars. They are not as deep here as they were over here, although the price is much lower here than it is here. That is called a double bottom bullish MACD divergence. I learned this by studying one-on-one with Dr. Alexander Elder. He loves double bottom bullish MACD divergences. Really what this is saying is, from a MACD perspective, yes, it's lower, but the numbers, the math that's involved in painting these bars was not as, the move down was not as strong as this move. So this is implying that you're running out of selling momentum and that you're running out of sellers. And if you run out of sellers, that's when you're going to go up. All right. Now, I'll take it one step further. Look over here. Here we made a new low. This low is lower than this low. Look at the MACD bars of this low, red. Now we're lower here and we have no red. This is called a triple bottom with triple bottom bullish MACD divergence with a missing right shoulder. It's called a missing right shoulder because this low doesn't have any red. It's all very bullish, but it doesn't mean you just jump in and you buy when you have these divergences. It's just giving you a high kind of altitude view that you're running out of sellers, and the implication is you're going to go up. But I still need a entry signal. And like I said, what I'm looking for next week is a rejection. Three things: a rejection of the high of the order block, rejection of the low of the order block, or a rejection of the 30 RSI. And the high of the order block here, 119.34, the low of the order block, 116.75 looks like. So those are the three levels that I'm looking at: the high of the order block, the low of the order block, or a rejection of the 30 RSI inside the order block. Dow Jones, DIA. Okay, so DIA did have a nice signal here on the 27th. I didn't buy it here, but it did reject the bottom of the order block. It went below it during the day, closed back above it, and it's moved up nicely since then. Okay, I didn't take the trade. I took, I can't remember, I took something else that day. But the green order block is something from the past. The blue order block, and they overlap each other, is something new. Why is it new? Because, look, swing low, swing high, lower swing low. On Wednesday, we took out that swing high, which created a new order block, defined a new order block, lowest closing bar before market structure change. Okay, so we have overlapping order blocks. So what I'm looking for next week, two areas. I'm looking for a rejection of either the 250-day moving average. The 250-day moving average right now is at 456.33. We're at 465.09. So the 200-day moving average, 456.33. If it rejected that next week, I would consider taking that, and then my stop from that entry would be a close below 456.33. Or if we go lower, we have the 300-day moving average. The 300-day moving average is the orange line, and that is at 452.34. And if we rejected that level, then I would consider taking that trade, and then my end of bar stop would be a close below the 300 of 452.34. All right, so that's what I'm looking for. I'm looking for a bit of a pullback and a rejection of the 250, or I'm looking for a rejection of the 300-day moving average. And most importantly, they are inside an order block. Let's go to Southwest Airlines. Love. All right, this is a little bit unorthodox of a trade, but let me show you right off the bat. We rejected the 200-day moving average on Friday, meaning we were below it, we closed back above it. Could I have taken that trade? I could have. I didn't. If I did, close below the 200 would be my stop. Below it is the 250. Below it is the 300. Now, there are no corresponding order blocks to the left where these moving averages live in. So I did go back and I tried to find something that would correspond with one of those moving averages. And what I found was this back here on 10/21/25. What is this? Well, this is a swing high that the market broke through. If you break through an area of resistance, that this high up until this day here was resistance, we broke through it. Once you break through it, what once used to be resistance is now support, ironically. So The market is coming back down to the support of that previous high at 34.70. Well, take a look, because remember, I like to look for confluences. Like to look for two major levels. Well, we have a 300-day moving average here at 34.58. That's a key level. And that previous high was 34.70. And they're very, very close, almost kissing each other, right? So what I'm looking for next week would be a rejection of 34.70. And if it rejected 34.70, that would be my end of the day stop, or a rejection of the 300 at 34.58. It's just 12 cents lower. And if it rejected the 34.58, I would use the 34.58 as my stop as well. But like I said, I don't usually show you these examples because there usually is an order block, but in this one there was no order block, but there is a previous high that we broke through, which now is support at 34.70. So either a rejection of 34.70 or a rejection of 34.58. The Qs. All right. So we did move up on the Qs. We didn't take out a swing high. We don't have a new order block, but we have the existing order block here where I first took the trade and then had to get out and then didn't get back in, right? But what I'm looking for, if we have a pullback, I'm not saying this is going to happen. I hope it doesn't happen, but it's certainly possible it could happen. I'm looking for a pullback to the 300-day moving average. The 300-day moving average is 562.52. Now, if it gets there, great, I'll consider it. If it doesn't get there, perfect. I'll find and wait for something that does. But I do like to mark these things up before the coming week and just have them there so I know exactly, oh, I said on the weekend, if it gets there, that's probably where I want to get. I'm sure you've done this too. I have friends that tell me all the time, I don't know why I didn't buy that. I saw that, I didn't write it down, and then it got there and I didn't take it. And then I thought about it and I said, why didn't I take this? I said this a week ago. If it does this, I'm going to do that. I'm telling you, there's a magic to it. On the weekend, go through your charts, mark up levels that you feel comfortable with, just like I'm showing you here. Doesn't mean it's going to get to the 300 at 562.52, but if it does, I should take notice, right? So again, if it rejects 562.52, 562.52, if it rejects the 300-day moving average next week, I will consider taking the trade, and my end of bar stop will be a close below 562.52. Oil, USO. I get a lot of people asking me about this. All right. You know, sometimes you look at a chart and you see something that's just so obvious. And to me, what I am seeing on USO, we just talked about double bottoms, bullish divergences. This is a double top with a bearish divergence. Let me explain. Look at this high here. Look how tall the green bars are. A lot of buying. Very tall. We go from green back to red. Now look up here. We are higher here than we were over here. But look at the green. Pretty anemic, right? It's nowhere close to this high. What is that telling you from a MACD perspective? It's telling you that the buying momentum, even though the price is up, the buying momentum is slowing. It means you're running out of buyers. If you're running out of buyers, what's going to happen? You will go down, okay? So, but just like I was showing you with whatever that was it Alibaba? Yeah, it was Alibaba. That you were running out of sellers. Here, this is telling me you're running out of buyers. Not only do we have a bearish double top with a bearish MACD divergence, we also have a bearish RSI divergence. Let me explain. Look at the RSI here at this peak. It was here. Now we are much higher. The RSI is here. It's lower. That's an RSI divergence. Let's look at the ATR channels. This top ATR channel is the 6 ATR channel. Here, I don't know where that puts you. Like the 10 ATR? Well, now we're much higher. We're only to the 3rd ATR channel. There are 3 major divergences going on here. Bearish MACD divergence, bearish ATR divergence, and bearish RSI divergence. Now, I want to be very clear. Just because these divergences are happening at the moment doesn't mean it can't continue to go up. For sure, it could continue to go up, but it's showing you long term that you are running out of buyers, and so the implication is it's going to go down. So yes, you have all three of these divergences in place, but I still need a legitimate entry signal. So what could that be? Well, what I'm looking at is potentially a gap down on Monday. If we gap down, we will have a bearish abandon baby. Here, we gap up, but if we gap down, now we have a bearish abandon baby. And if that happens and it's the right spot, 2 ATR stop above, 4 ATR profit target below. I know it's scary to short oil right now, of course, with everything that's going on. But I really, if I have a signal, I take it, right? The other potential entry that I'm looking at is if we look at the trend line here, we have this swing low here, and we have this higher swing low here. And if you connect these two swing lows and take the trend line out into the future, very often when you do that, if you reject the trend line, that could be a short-term top. We have not rejected the trend line, but here, let me give you an example. Had we done this on Thursday, it rejected the trend line and closed back below it, I would consider shorting oil there. And how would I do the trade? Well, 2 ATR stop above, as always, and then a close back above the trend line as my stop. So I don't know what's going to happen here. Doesn't mean I'm going to take this trade, but it means that I'm looking for a legitimate short trade. And right now for me, it would be a bearish abandon baby would be one option, or a rejection of the trend line. And that trend line's, the number's going to be different every day as it moves. So I can't tell you exactly, but roughly kind of up here in the 147 level, maybe $10 higher. So rejection of the trend line or a bearish abandoned baby would be my two entry signals. But the reason I'm really looking at this is because of the bearish MACD divergences, bearish ATR divergences, and bearish RSI divergences. Last one is XLV. XLV really has come way down. I have two order blocks here. We have the previous order block from the past, which is the green, and we have the new order block in the blue. Again, why is this new one here? It just happened. Swing low, swing high, lower swing low, market structure change. Once we change market structure to the upside, I look for the lowest closing bar prior is this guy right here, high and low, bring that into the future. I have three legitimate entries to look at. The first is the 200-day moving average, the black line, at 145.76. It was not in an order block prior to a couple days ago. A couple days ago, we broke out over this high, so now it makes a new order block, and now this 200-day moving average lives inside that order block. So I'm looking at three levels for next week. I'm looking for rejection of the 200-day moving average, which is 145.76. Potential entry there. My end of bar stop would be 145.76. If we come lower, I could test and see if we reject the 300-day moving average. The 300-day moving average is 144.05. If it rejects it and I take it, again, 144.05 would be my end of bar stop, or lower to the 250-day moving average. The 250-day moving average is 143.56. If we go lower, reject that level, I could key off of that level, and my end of bar stop would be a close below 143.56. So that's what I'm looking at right there. Those are my 6 symbols. I hope you found today's podcast helpful. Again, if you did, I really would appreciate if you could hit the thumbs up button or subscribe. I would appreciate either or both of those. Thank you very much. I always like to leave off with, please try to go out and do something nice for somebody if you have the opportunity each day. It just would make the world a lot better place if we were to all do that. One nice thing for somebody else every day. I'm a big animal lover. If you have the opportunity to do an act of kindness for an animal, again, if you have the opportunity, that would be great. They appreciate acts of kindness just like we do, right? The world seems like a mess right now. I think we need to be kinder to each other, right? So thank you for being here. Listen, if I can help you with your trading, I'd love to have you as a student. I also do consulting. with hedge funds and also other large financial institutions. I teach options. I teach lots of stuff. If I can help you with anything, please let me know. I'll do my very best for you. And my email's in the link. So thanks, everybody. Have a really good rest of your weekend. If you have any comments or questions about the podcast today, put them in the comment section. I'll do my best to get back to you. But thanks again for taking the time, and I hope you found it helpful. Thanks a lot, everybody. God willing, I'll see you next week. Bye-bye.
Disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.